Good evening, class, and welcome to our MI class. Today, we'll be taking a particular topic. Excuse me. Sorry. Let me share my screen so that we can see the topic for consideration today. Okay. We are going to be taking lecture number 5. The title is Short Term, not 10. Short-term decision-making techniques. I will not go through the rules for the class because I know you know the rules and you've been keeping them. So just a reminder, the rules are to be kept. Short-term decision-making. At the end of this lecture, you will be able to analyze relevant costs and to decide whether you want to make or buy goods. Then you're also going to analyze relevant costs to price contracts. We did that a bit last week when we did relevant costs. So I want us to keep our mind open on what we did in topic number 4 when we talked of relevant costs. We saw all those costs that are relevant. These relevant costs can be applied to both short-term and long-term decisions. So what are short-term decisions? These are decisions where the financial consequences occur soon after the decision is taken. For example, a short-term decision may include a result of an additional increase in cash flow or profits. So we find out that short-term decisions are results that occur almost immediately, perhaps within a month, within a quarter, maybe perhaps within a year. These are short-term decisions that you can make. So when you make decisions that comes in short term, you are making them for like 1 year, maybe 6 months. These are short-term decision making. Okay. Now, a long-term decision is one where a capital investment is required and the benefits last for over a period of several years. So now you are not making a decision of what to sell, how to make profit within a year or so. You are making a capital investment. Okay, what assets am I going to buy that will last me for 5 years, 10 years, and so on? What kind of loan am I going to obtain that I'll finish paying back in like 5 years? All these are long-term decision making. So the concept of relevant cost we discussed last time can be used or can be applied to short-term or long-term decisions. For the purpose of this lecture, we are going to be talking about short-term decision making, how we can use relevant costs to make these short-term decisions. Okay, we are going to be looking at majorly 2 of these decisions, make or buy or shut down. These are the 2 that we are going to be looking at today. Make or buy decision. We call it outsource or in-house decision. Now, what is make or buy? Now, look at the name. You make or you buy. This shows you decisions you could take. So you have a decision either to make something internally or to buy it from an external supplier. Let me give you an example. You want to make soft drinks. You have the capacity of making soft drinks. You can either make these soft drinks or you go outside there and buy them. Or you are a manufacturer of soft drinks, but you also have the capacity to make the bottles or to make the crown cork. You can decide to source that crown cork externally, or you can make it. Now, what are the basis for you to decide if you want to make these components or these goods yourself, or you want to subcontract them? So the economic basis for the decision whether you want to make or buy should be based on relevant costs. So from the financial point of view, anyone that gives you a lower relevant cost should be chosen. So we've looked at relevant cost last time, and when we are looking at labor, the other time in labor, we saw that there were two alternatives, and the company opt for the one that gives them a lower cost, a lower relevant cost. So that's what we are going to be applying here in make or buy decisions. We are going to be looking at which one gives you a lower relevant cost. From a financial point of view, when your cost is low, your profit is high. And so you go for the one that has a lower relevant cost. So now, what do we do when we decide to compare relevant costs to choose which one is appropriate? First, a financial assessment of make or buy decision involves a comparison of the costs that will be saved if this work is outsourced or subcontracted. So we look at, if I'm going to do this job now myself, I'm going to spend a particular amount of money, right? Okay. If I don't do this job myself and I subcontract it, okay, I'm still going to spend, how much am I going to spend by subcontracting it? So that's one of the costs you are going to be looking at. Then how much are you going to get as benefit when you subcontract? Well, we'll look at it, an example, and you understand make or buy decisions. Look at one example here. Example STD01, make or buy decisions. Here, a company manufactures a component that is included in a final product that it also manufactures. Now let's look at this question and be thinking about this. It makes a component which is included in the final product. Let's assume that it's a soft drink company producing the bottle that is going to be used to make the final product. So management have identified an external supplier who will be willing to supply the component. So in place of component, let's call it bottle. Who will be willing to supply the bottle? The variable cost of manufacturing the bottle internally is 100 naira. And the external supplier would be prepared to supply the components for 130 naira each. So that you'll be thinking, why should I make it myself, or why should I give it out to others? And you are starting to look at relevant costs. We said variable costs are relevant costs. Fixed costs are not relevant costs. So you'll be looking at it, okay, there is no fixed cost mentioned here. We are told that relevant cost is the variable cost is 100 naira. Purchase cost is also 130 naira, and it's also a relevant cost. So you will be tempted to say, why not make it in-house? Because this is the lower. I will spend lower making it myself than spending a higher of 130 doing it outside, subcontracting it. Okay, but look at the next story. It has been estimated that cash savings on general overhead expenditure will be 48,000 naira each year if internal production is ended. Internal production is making it in-house. So what they are saying here is, if you decide to stop making it in-house, your overhead will reduce by 48,000. But if you go ahead to make it in-house, your overhead will increase by, your overhead will not increase. That 48,000, you will not save it. You will not save it. So the company needs 1,000 units of the component each year. Should the company make or buy the component? Now let's look at how we can use relevant costs. Now, the extra costs of purchasing internally, that means what is the extra thing you are going to spend if you had purchased it internally, externally rather. Normally, you are spending 130 naira for one if you are buying it outside. But if you are doing it inside, you are spending only 100 naira. So what is the increment? That is the extra cost. Because anyhow, you will spend 100 naira. But would that 100 naira be for variable, or would that be for external? If it is external, you will spend 100 naira, no doubt, plus 30, which is 30 naira is the incremental cost. So you can see why we say 130 minus 100. That's the incremental extra cost of purchasing it outside. Now, if you're buying 1,000 units, that will mean that 30 naira multiplied by 1,000, it means you are spending extra 30,000. So if you are spending extra 30,000, is it a good thing? Now, the question that says, if you decide to produce it in-house, well, you will not save any costs. But if you stop producing in-house, what will happen? You will save 48,000 naira. And so 48,000 naira becomes your revenue, just like it increases your revenue, because you are not spending that on expenses, so your revenue is increased, your profit is increased, your contribution is increased by that 48,000 which you save. So how much did you save? 48,000. How much did you spend? 30,000. That means your benefit of giving it outside, the extra benefit, is 18,000. So that is a very good position. If you had not given it outside, then you would not have gotten this extra 18,000. So you see, make or buy, you look at what is the savings benefits coming to you in the form of cash savings. Then how much are you spending? So the trade-off, she gives you which one of them give you a higher benefit, you go for that. Or if you look at them in terms of costs, only costs, which one of them give you a lower cost, you go for that. So you look at it, if it is only cost presented, which one of them will give you a lower cost, go for that. Which one of them will give you a higher benefit, you go for that. So the rule for make or buy is compare your variable costs with your purchase cost, and whichever gives you a lower cost, that's the one that will give you a higher benefit. So you see the conclusion here, the company would increase its profit by purchasing externally instead of making the items in-house. Okay, so that's for that. We'll now go to the next one, make or buy decisions with scarce resource. Now, the first example we did, there was no scarce resource. And when we talk about scarce resource, our mind goes to limiting factor. So when we say scarce resource, it takes us to the idea that we will want to make everything, but we cannot make it on our own alone. Or we don't have all the resources that it takes to make everything we want to make. And so we have to decide, should we make in-house? Should we outsource? And if we are going to outsource, which are we going to outsource so that we will get the optimal benefit? So that this one will help us to understand limiting factor again. So this topic is like a combination of limiting factor and relevant costing. So you see why it is coming after we've talked about limiting factor and relevant costing. You understand it now. A situation arises when an entity is operating at full capacity. That means they don't have spare capacity, but it has the opportunity to outsource some production in order to overcome the restrictions on output and sales. So you see, when we are doing limiting factor, we usually said that when we get our limiting factor, contribution per limiting factor, and we rank, we produce according to the ranking. And perhaps the last one will be limited due to space, due to inability for us to have more resource. So we trim it down to what the remaining resource can carry. Now, what do we do to the ones that we did not produce? Let's say you're supposed to produce product X, 500, but you could only produce 200. So what do you do with the other 300? Now that 300 that you cannot produce, you won't tell your customers that, look, oh, I cannot give you the whole 500. You must look for a way. So you have to outsource that 300 to another company making the same kind of products that has spare capacity that can accommodate that. So you don't have much more capacity. This is what your capacity can carry. So you have to give the remainder to the other company to help you produce so that you can supply your customers' demand without failing them, and you do not lose out totally. You make the maximum contribution that you want to make. So in this type of situation, a relevant costing approach is to assume that the entity will seek to maximize its profits and therefore outsource some of the work, provided that profit will be increased as a consequence. So if you are going to outsource the work and you are not going to increase your profit because of outsourcing, then there will be no need for you to outsource. But if you're going to outsource, that means that whatever you are spending will be smaller than what you are getting. Fine. But that doesn't mean that you have to now outsource and spend much more money. So you outsource the one that you spend the least and make the most. The decision is about which item to outsource and which to retain in-house. So the profit maximizing decision is to outsource those items where the cost of outsourcing will be the least. So you outsource the one that will give you the smallest cost. So to identify the least cost outsourcing arrangement, it is necessary to compare the additional cost of outsourcing production of an item. That is what we did in example 1. That extra cost of outsourcing. So you remember when we were doing limiting factor, we said find your contribution per unit. But in this make or buy with scarce resource, we will say find the extra contribution or extra costs of outsourcing. That's one. The second one now is you compare with the amount of scarce resource that will be needed to make the item in-house. So costs are minimized by outsourcing those items where the extra cost of outsourcing is the lowest per unit of scarce resources saved. We're going to look at some examples to illustrate what we've just mentioned here. Okay, look at illustration 2. Make or buy with decisions with scarce resource. Now, a contract cleaning company provides 3 services. These are daily office cleaning, intensive cleaning of office space, and minor repairs. These are the 3 services. However, it has insufficient resources to do all the work available. So you see, it wants to do all these 3 services, but where is the resources to do all of them? It cannot do all of them. And so the question says, and wishes to use a subcontractor to take on some of the work. So now the problem is, how will they know which to subcontract? The question continues. Information relating to the different type of work is as follows. Now look at the average labor hours per job. Look at the budgeted number of jobs. Look at the variable cost per job. And look at the subcontractor quote. That means how much you're going to pay the subcontractor per job. You look at the daily office cleaning. The average labor hours is 4 hours per job. It's as good as saying 4 hours per unit. You are used to per unit, so we are taking it now to per job. Budgeted number of jobs or units, we say this is 1,500 units or 1,500 jobs. Now look at the variable cost per job or unit is 600 naira each. If you look at the subcontractor is telling you 800. Just looking at daily office cleaning, find out that subcontractor's price is higher than the variable cost. So you'll be tempted to do the job. That's fine, because when you compare these 2 relevant costs, it tells you you should do it. The same thing with intensive cleaning. When you compare the variable cost with the subcontractor cost, you are tempted to say, let's do it in-house. The same thing with minor repairs. Let's do it in-house. But can you? He said there are 8,000 labor hours. 8,000 labor hours available. When they tell you there are 8,000 labor hours available, it shows that there is a restriction. You quickly do something. is this 8 hours enough for me? That is what you'll be asking yourself. Is this 8 hours enough for me? Let's see. Okay, how do we know? One, this office cleaning takes 1,500 jobs multiplied by 4 hours per one job will give you 6,000 hours. So that's one. You now add that, you add that to the second one. Second one is 400 jobs multiplied by 6 hours per job gives you 2,400. By the time you add them, you have already exceeded the 8,000. This is 8,400. And that is not even all. You are having again 640 multiplied by 300. You are getting 1,920. At the end, you are having 10,320 hours required to do the job, but you only have 8,000 hours. So you see whether your decision is telling you do all of them is cheaper for you. You have to look at your restriction. Your restriction is saying, yes, I cannot do everything, so I have to subcontract. The question here says, which services are to be subcontracted and what is the total monthly variable cost of the company? So let's look at the solution here. Let's look at the solution page here. Sorry, a moment. Okay, so my solution is here. Okay, now look at your solution. The problem here is to decide which job to outsource or to subcontract. Now, the ranking of the jobs is established as follows. Now look at what we do. What is the cost of doing the jobs in-house? These are the costs: 600, 180, 1,080, and 560. These are the things here: 600, 1,080, and 560. Now, what is the subcontractor's quote? We have it there as 800, we have it as 1,005, and we have it as 1,000 naira. Fine. Now, if we are to compare the two of them, what is the extra cost of doing the job outside? So if we give out this daily cleaning, we'll spend extra 200. If we give out daily intensive cleaning, instead of making it, we'll be spending 420 extra. Here, in minor repairs, we'll be spending 440 naira. So you see, these are the extra costs. But how do we know that these costs, which one of them are we going to save that we can save more? So we now look at it now. If we decide that we are not giving this job out, and okay, we decide that we want to give this job out, we find out that if we say that we're not going to do daily cleaning, we want to give it out, that will mean that we will not do the job. That will mean that we will save ourselves this average labor hours per job because we are not doing the job. So we are going to save this amount per job, this amount per job, and this amount per job. And mind you, that is our limiting factor. So all we are doing is extra costs of outsourcing. Then we divide it by our limiting factor here, which is 4, 6, and 3. So when we do that, when we say 200 divided by 4, That gives me 50. 420 divided by 6 gives me 70. 440 divided by 3 gives me 140. Now what it means is that if we decide to give out daily cleaning, this is what we are going to save. That means in all our resources that are limiting factor, we are going to be saving 50 naira. This is what we are going to save by giving the job out. 70 naira on intensive cleaning. This is what we are going to save, 140 on minor repairs. So you see, what will you want to give out first? If I'm supposed to save 140 for giving you the job, if I'm saving 140 for giving you the job, which one? Okay, sorry. If I'm going to save 140 because I subcontracted, that would mean that I'm going to give you this job that is 50 because this is the least cost I am going to save. This is the least cost I am going to save. So I'm giving you out. That is my priority list for subcontracting. That will mean I will give you this job out because that is the least I am saving for giving you out. If I give you this one, that is the highest cost I'm going to save. So that would mean that if this one goes out first, I'll be losing this 140. So I would prefer to lose 150 than to lose 140. So you see, the priority for outsourcing, the one that has the lowest rank, the one that has the lowest value is ranked first. The one that has the highest value is ranked last. While for doing it indoor, in-house, it's just like what we did in limiting factor. The one that has the highest figure is ranked first. So if we do it in-house, we are saving 140 by doing it in-house. We are saving 50 by doing it in-house. So which one will I want to do? I will do the one that will give me the highest savings. That's why I'm doing this first. I will give out the one that will give me the least savings. That is why I'm giving this one out as number one. I don't know if you understand me. So the one that is ranked higher is the one I will do first, followed by the lower one and the lowest. So I will follow the reverse. That would mean that the one that is ranked last for doing it in-house is what will be ranked first for outsourcing. Now, look at the comment here. The company can do all the 3 types of job more cheaply with its own staff than by hiring. You see, they can save cost here. Look at all the cost they can save by doing them. However, provided it earns more than 800 naira for daily cleaning, or more than 1,500 for intensive cleaning, or more than 1,000 for minor repair of a job. So it is profitable to hire a subcontractor to make up for any shortfall of the in-house resource. So what we're going to do is we are going to look at our production schedule, and we are going to start with what we can do. So we'll start with what we rank first and start doing it using up our resources. Then we'll move to the second one and use up our resources. Then when we get to the third one, we'll use whatever resource that is available, then the remainder we'll give it out. Okay, so that is what it means. So the production plan. So look at the production plan here. The production plan here is to do minor repairs, which is the first one. So we are looking at minor repairs as our first one here, because from here we ranked it first. We rank minor repairs first. So if we rank minor repairs first, how many hours does it take for one job of minor repair? It takes 3 hours. So if it takes 3 hours for one job, and we are doing how many number of jobs here? We are doing, 640 jobs. So what do we do? 3 times 640. That is 1,920. So that's the total hours we are spending. 1,920 for doing these minor repairs. The question also asks for our variable cost. So what is our variable cost? So what it means is that how much are we going to spend doing it indoors? We're going to do it, the first is this, which is 560 naira. It's our variable cost. So you come again, 560 multiplied by how many jobs here? Multiplied by 640. You multiplied by 640, what you get is 358,400. That is your variable cost here. I believe that's clear. Then we go to the next one, which is intensive cleaning. We see that that is the second for priority for doing that job in-house. Intensive cleaning. How many are we supposed to do according to the question here? Intensive cleaning is 400, and it takes us 6 hours for the job. So I will say 400 for all the jobs multiplied by 6 hours per job to give me 2,400. So 2,400 is my total labor hours. So we are doing 400 jobs, 2,400. So what will be my variable cost? My variable cost is 400 jobs I'm doing. Variable cost is 400 jobs I'm doing multiplied by, what is the variable cost per job is 1,080 multiplied by 1,080. And what I get here is 432,000. So that's what I got, 432,000 here. Now we notice that the last one cannot be fully done. So all we need to do to get this figure here is to say 8,000 hours, which is the total, minus, we start opening the bracket. We've done 1,920 before. You now did 2,400. If you close the bracket, you would have done 4,320. When you do 4,320 and you minus it from 8,000, what you are getting is 3,680, which is this 3,680 you got here. Now, having gotten 3,680, how do we know the number of jobs we can do? Because, of course, we cannot do the whole 15 jobs. But what do we know? We know that it takes us 4 hours to do one job. So if it takes us 4 hours to do one job, and we have a total of 3,680 hours, it takes us 4 hours to do one job. That gives us 920. That means for this amount of time, it requires 920 jobs. After getting your 920 jobs now, what is your total variable cost? It will be 920 multiplied by what's the variable cost here? 800. 800. So multiplied by 800 gives you, sorry, this cleaning, office cleaning. Oh, sorry, I went to take 800. It's supposed to be 600 variable cost. 600 multiplied by how many jobs? By 920. Let me see. Multiplied by 920. Yes. Multiplied by 920. That gives me 552, which is what is here. So when we add 552 to 432,000 plus 358,400 for just in-house, you are spending a variable cost of 1,342,400. So that's your variable cost is not done because you have succeeded in supplying everything, but this one is 920. Meanwhile, you are supposed to do how many? 1,500. So what do you do next? You will say, out of 1,500, I only succeeded in doing 920. That means I have 580 that I have not done. I need to subcontract this 580. So if you look at subcontractor, the office cleaning is still there. I am subcontracting the 580. I don't care about labor hours because I'm not the one doing it. They are the ones to care about labor hours, and they said we have spare capacity, so they must have done that. So, but 580, what we do now is to look at not the variable cost now. We're going to be looking at the cost of subcontractor because they're the ones doing it now. You will now say multiply by 800. Multiplied by 800. That will give you 464,000. So 464,000. When you add that to what we got in-house making, you have a total of 1,806,400. Now that's the total variable costs that you are going to make. And you've seen how you can outsource. It's only one you are outsourcing, which is which is office cleaning. You are outsourcing 580 number of jobs. Let's take the next question. Let's look at the next question. Now, a company makes 4 products. We call them products W, X, Y, and Z. Now, these are the 4 products the company make. All the 4 products are made on the same machine. Now, when they are telling you all of them are made in the same machine, you know that they are trying to tell you something is limiting. That is the cue for you to know that limiting factor is coming. And now the machine capacity for the year at Wombat's factory is 3,500 hours. So now they have given you the machine hours that is required here. That's fine. The company is able to obtain any of these products in unlimited quantities from a subcontractor. So you see that they can get any number that they require from the subcontractor. But what is stopping them from getting everything from this supplier? What is stopping them? They can also make it. Could it be that the subcontractor is going to be charging higher for what they can make lower? Let's go on. Look at for product WXYZ. We see the annual sales demand in units, 4,000, 6,000, 3,000, 5,000. We also look at the selling price per unit. Excuse me. In Naira there, this is 150, 200, 180, 170. If you look at the variable cost per unit, you find out that the variable cost here is 50, 70, 60, and 70. But look at the cost of purchases, 80, 118, 105, and 110. You can find out that the external cost of purchasing is higher than the cost of making it in-house. So if the cost of making it in-house was higher, you will be justified in buying outside. But now you are justified for making it in-house because your variable cost, which is the relevant cost, is lower than the purchase cost. So as much as possible, you want to do it in-house to the extent that you can carry. Now look at the machine hours per unit, which is the limiting factor, which is always going to be given to you. Required. Which items should be produced in-house and which should be outsourced? And calculate the total costs associated with the optimal plan. Now, this is like the one we did the first time. Which one should we produce in-house? Which should we outsource? So what's the first thing we should do here? Let's look at the solution. What's the first thing we should do? Now, the first thing to do is to find a way to get a ranking. Look at the product X, WXYZ. Making it in-house, the variable costs, we have 50, 70, 60, and 70. Fine. Look at the cost of buying them out from that subcontractor. They are all listed here. We find out that the subcontractor costs are higher. And so, if you decide to make them in-house, you are going to be saving 30 Naira, which you would have given the subcontractor. You'll be saving 48 Naira, which you would have given to subcontractor. So that is what we call external cost of saving. You'll be saving all of this per unit. Wow. You might say it's small, but the impact will be felt when you are doing a large quantity. Now look at the machine hours per unit, which is the limiting factor. The limiting factor here, they said the machine hours is 0.25, 0.5, 0.3, and 4. So when you divide by this extra cost of outsourcing per unit, we say 30 divided by 0.25. Let's do it ourselves here. We have 30 divided by 0.25. We have 120 as stated in the answer there. Then the second one is 48 divided by 0.5. We have 96. Good. We have 45 divided by 0.3. We have 150. Fine. And 40 divided by 0.4. We have 100. That's good. So this is the machine hours saved. Extra cost of machine hours. Extra cost of outsourcing per machine hour saved. So it means that 120, 150 will be best saved when we do it ourselves. That's why priority for in-house, you see 150 under the product Y is ranked first. The second one is product W that ranked the second. the third is product Z, and the last is product X. So when you've done your priority for outsourcing and your priority for in-house, you know that for outsourcing, the one that is the least takes first. For in-house, the one that is the highest takes first. So that should be your mentality. Now look at the costs maximizing profit budget, cost minimizing and profit maximizing budget, which is what we call the optimal production budget. Now, look at the in-house production. Because we are doing, because we are doing Y first. Y is listed here first. Second one is W. The third is Z. So if you see, the question told us that Y, Y is 3,000 units that must be used. So that's why you see your 3,000 units here. So this 3,000 units, how many machine hours will it require? If Y requires 0.3 hours for 1 unit, so let's do it, 0.3 multiplied by 3,000 units. That's 900, as stated here in this solution. What about W? W is needing 4,000. So that's 4,000 here. We look at W again. What is the labor hours per unit? 0.25. So you say 4,000 times 0.25, which is 1,000 machine hours. 1,000 machine hours. Mind you, how many machine hours are we looking for here? 3,500 hours. We shouldn't exceed above it. So what we will now do is to add up these two that we found. 900 plus 1,000 gives me 19. What's the difference between 19 and 35? It's 16. So what do we do? How do we know that once this Z cannot take 16? All we need to do is look for Z. Z is supposed to be 5,000. If Z is 5,000, so let's do it together. 5,000 units, and we require 0.4 to make Z. What do we do? Multiplied by 0.4 to give you 2,000. But we're looking for 16, so it is more. So all you now do, you have your 16 that was remaining, and you just divide by 0.4. That gives you 4,000 units. That is what you are going to use, 4,000 units as against 5,000 units. So you now use 4,000 units multiplied by 0.4 gives you 16. Now, what are their total variable costs? The total variable costs, you will use the number of units. Let me show you the example, the Z. This 4,000 units multiplied by what is the in-house cost for Z? 70 naira. Multiplied by 70. That gives me 280,000. That's what it gives me. So you see, that's the same 280,000. I see here 280,000. That's fine. Now you find out that you've outsourced, you've done Y in-house, you've done Z and W in-house, you went to the third in your list, which is Z, and you couldn't finish it. Remember, we are supposed to do 5,000 units. You only did 4,000. So in your list of outsourcing, what was your first? Your first was what? Your first happens to be what? Is that X? Sorry. Your first happens to be, what's happening here? Sorry, your first happens to be X for outsourcing. X. And your Z is your second. So it is your Z that was your second. Anyway, you can still do your Z first before you do your X, because you started this one already. So you have to give out the balance first. So the balance of 1,000 must be given out. You are not caring about the order now in which you give out the outsource, because you've taken all the ones that you are going to do in-house. So the rest can be outsourced. It means your Z, you can outsource 1,000. And what is the quote for 1,000 for Z? It's 101 naira, 110 naira. So when you do that, 1,000 multiplied by 110 gives you 110,000. Then the whole of X, that is 6,000. So all you need to do is 6,000 multiplied by, what is the quote? The quote should be 118. 118. So that will give you 708,000. So when you add your 708,000 plus 110,000, which is this here, then you add everything here. I didn't do subtotal like I used to do, plus 280,000 plus 200,000 plus 180,000. You find out that it is 1,478,000. That is your total variable costs. So you can see that make or buy, we consider relevant cost. Now give me some minutes. Hold on. All right. Now, irrespective of the fact that you need to outsource or make in-house, it is good to consider non-financial considerations. All the while, we have been using financial consideration here. We've been talking about sourcing, for which one will give you the least spend. Source that one out first and all that. Look at the non-financial considerations. Now, in reality, managers think about non-financial issues. It will depend on the circumstance and varies from one decision to the other. Non-financial consideration can influence a decision. And so in your exam, be prepared to identify relevant non-financial issues and discuss their potential implications. So some of these include when the work is outsourced, the entity loses some control over the work. So it will rely on the external supplier to produce and supply the outsourced items. Now, because you've lost some control, you are now relying on the external supplier. So there may be some questions that there may be some risk that you face with that external supplier. For example, will they produce item of lower quality or of lower standard? So you see, because you don't have major control, you have to ask yourself, are you not running a risk of getting substandard, lower quality goods being produced? Now, will they fail to meet your delivery dates on schedule? So if they fail to meet your delivery dates, you will lose the customer. Okay? So if the customer comes and you say, I don't have all of them, I went my co-supplier is coming, but he's nowhere to be found. You lost the customer. Now the entity will also lose some flexibility. To lose some flexibility. And the decision to outsource work may have implication for employment within the entity. And it may be necessary to make some employees redundant. Okay? So look at some of the non-financial costs. The next one we're going to look at is one-off contracts. What is a one-off contract? We mentioned that in when we are studying relevant costs. That one-off contracts are those contracts that will not be repeated in the future. They just come up just one. They are special contracts, and we use relevant costs to decide whether we will agree to do the job or not. Now, in this situation, the customer is offering us something smaller than what we would normally charge. But we ask yourself, before you say, no, this thing is too small, use relevant costs to find out if you're going to make profit from this or you're going to make loss. Or you're going to make contribution or you're going to make loss. Okay? One-off contract decisions might occur when the company has spare capacity, fine, and an opportunity arises to earn some extra profits. So because you have spare capacity, you can do some certain jobs and increase your profits in that available time that you are whiling away. Okay? This type of analysis should not be applied to most decisions. However, because a company must earn sufficient profit in total, every situation or not in every circumstance, that you have to use relevant cost, because relevant cost says you only consider your variable costs. You're not even looking at your fixed costs, but normally you must have some fixed costs in order to make some profit to cover your fixed costs. Look at STD04. It says here, contractor limited is deciding whether or not to proceed with a one-off special contract for which it will receive a one-off payment of 200,000 naira. So that the customer has offered 200,000. Now look at the details of the job. The special contract requires 200 hours of labor, and that labor is paid at 600 naira per hour. Employees possessing the necessary skills are already employed by Contractor Limited, but are currently idle due to recent downturn in business. Now, what do you think? We'll start asking the questions. You start asking yourself those questions about labor. Now, materials X and Y will be used. Now, look at the terms 10 tons of material X will be needed, and sufficient material is in inventory as the material is in common use by the company. Original cost of material in inventory was 150 per ton and all that. Look at material Y. You see that they have plenty in the store due to over purchasing. They gave us the original cost of producing the Y. And we are told that if we don't use the Y is toxic. So we cannot just say, okay, let's leave it. We have to either use it or dispose them. To cost us 24,000 to dispose them. Okay, look at C. The contract will require the use of storage unit for 3 months. The contractor is committed to the rent. We know have committed costs. Okay. Then we also see an opportunity cost here of offering the units to some other contractor for 11,000 naira per month. Now we look at D. There is an overhead absorbed, 750, broken down into fixed costs, 500 and 250 variable costs. Now look at the next set of things they told you. A trainee accountant, just like you, a trainee accountant, has performed the following calculator, which shows that the contract will cost 259,000 to deliver, and conclude that the contract should not be accepted for 200,000. Now look at how the trainee accountant did. Now look at labor. Look at what she calculated for labor. She said labor, the relevant cost would be 120. But is that true? Look at how she got at 120. She said, okay, let me bring this one down so I'll be looking at it and be seeing. Okay, look at where she did labor. She said 200 hours times 600. So that's what she did here. 200 times 600 gave her 120. Then material X, she said material X, it will require 100 tons, so that's 100 multiplied by how many? Original cost was 150. So what she did was say 100 times 150, which is 15,000. Of course, you are knowing that he or she is not correct. Then material Y, you see original cost there, material Y, 50,000, and that's what they put there. Of course, it's not correct. That's storage, 3 months times 8,000. How did she get 3 months times 8,000? Look at storage again. The contract will require the use of storage for 3 months. That's where the 3 come, 3 months. Where do we get the 8,000? The contractor is committed to rent the unit for one area at a rent of 8,000 naira. So that's what she did here. It gives you 24,000. Then overheads, he or she now brings the whole full figure, 750 multiplied by 200. So it's the same 200 that we use for labor. Okay. So, overheads, 750 multiplied by labor per labor hour. You see, it's per labor hour. So if labor is 200 hours, If labor is 200 hours, that it was what they did here, 750 naira times 200 hours gives me 150. So when you add these 5 figures, gives you 359,000. We are now required to calculate the relevant cost of the contract and advise whether the contract should be accepted or not on financial grounds. We are not told to look at non-financials, just on financial grounds. What do? Okay, we look at this computation again. We notice here that our trainee has multiplied 200 hours, which is what the labor need, by 600 naira per hour. But if you look at it critically, when we are looking at the relevant cost of labor, we ask ourselves, is the labor in permanent employment? Yes, we can say so, because they say necessary skills are already employed. So that means they're not going to hire people more, the people in employment. Do they have spare capacity? Yes, because they are currently idle. And when we say they have spare capacity, what do we do? What is their relevant cost? The relevant cost is nil, because anyhow, they have to pay them for their idle time. So there is nothing special paying them again. 600 naira for being idle, for using their idle time that they have already been paid for to do the job. And so instead of saying 200 hours times 600 naira, it should have been 200 hours times 0 naira, which will give you 0. Now look at material X. The person says 100 tons is required, yes, and 150. We look at it again. It's 150. That was the internal inventory costs, original inventory costs. So we know that original cost is sunk cost. It is not relevant. What is relevant is the market cost of 180. So all we need to do is 100 multiplied by 180. I think that's what the solution is saying here. Let me open the solution here. I think that's what the solution is saying here. Good. So it's 180 to give you 18,000. Now look at that of Y. That of Y, the person now brought the original cost. The original cost is no longer relevant. But what is relevant is this disposal cost. It means if you don't use the material, you have to dispose it because it's toxic, and you will spend 24,000. Is it not better for you to use the material and save 24,000? So we are looking at costs. When we are saving costs, it's a negative cost to us now because we are saving it. So we'll put it in brackets. It becomes a revenue to us. So you see, he doesn't have to dispose the 24,000 naira again as disposal cost. So he's saving it. So you see where it is being put in bracket, saving the cost, 24,000. Then look at the storage materials for 3 months, 8,000. This 8,000 was gotten from the contractor committing to the cost. We said committed costs are not relevant. So you can't be planning based on committed costs, because your person will have to pay the 8,000 naira per month. It's committed. But now the opportunity cost is 11,000 per month. So the person is already committed to giving you 8,000 naira per month, and you have seen an opportunity for 11,000 per month. What is the difference between 8,000 and 11,000? So 11,000 minus 8,000. So this is the opportunity cost, the cost you are foregoing for not renting it out to somebody else except the contractor. So that extra cost is what you are supposed to be using. So it's 3 multiplied by 11,000. But that's 3 months. 3 months multiplied by 11,000 instead of 8,000, because 11,000 is the opportunity cost of leasing the place out to somebody else instead of that committed cost. So 11,000. Now we also have fixed overhead is not relevant, because the question here says there will be no total fixed overhead are not expected to increase. So it doesn't, it's going to remain stagnant whether they do the cost, the job or not. So it doesn't concern us. Therefore, the relevant overhead cost is just the variable part, because of course, you know, if they're doing the contract, variable cost will increase. So you say 250 naira multiplied by 200 hours instead of 750 multiplied by 200. So you get 50,000. So put all of them in the table here. You have your 18,000 for labor. For material X, your labor is already 0. Material Y, you are saving 24,000. Put it in bracket. Storage, the opportunity cost there was 33,000. And the overhead, the variable cost is 50. So if you look at it, total cost that is relevant is 82,000. Conclusion, the contract should be accepted because this is the total relevant cost. So they should accept the 200,000 a man is offering because on relevant cost financial basis. Summary, we have been able to analyze costs and to decide whether we are going to make or we're going to buy. We look at the cost savings, extra benefits or extra savings we'll make if we do the job instead of subcontracting. That's what we are saying now. Now we have analyzed costs pertaining to one-off contracts. I don't know if you have any question now. Let me see if you jot down any question for me. Oh, I can't see any question. So that means you understand the topic. Okay, let me unmute you and let's talk. So do you understand the topic?
Hello.
Do you understand the topic?
Hello, can you hear me?
Yes, I can hear you. Do you understand? You understand it?
Yes, I did. But the only aspect where I will need clarification, you know, the second example that we treated. What if the quantity that's to be produced, like when you have higher the quantity, when quantity drives, how do I explain this now? When, okay, like, if you are doing printing, you are doing printing now. Yeah, if you are doing the printing, they will say when you want to do a larger quantity, it brings down the price.
Okay.
You get where I'm driving to.
I get what you're saying.
Larger the volume. So now, if we now contract because the cost is lower, and we say, okay, because of the limited man hours that we have, we should contract this so much quantity out. What if that will increase the cost?
Okay.
Can anything like that come up in the examination?
It may not come up,
I
but
hope you got my question.
Okay, I got your question. So that's one that we
Okay.
subcontracted instead of us doing the 920 and give the 580 out. Why don't we give the 015 out? Because maybe the higher the quantity, the lower the cost. Okay, if it is that way, because the price is not static like the one we did in the example. All you may need to do is you will do how much it would take if we subcontract everything to the consumer, how much we are going to spend, and how much we are going to spend on that alone if we subcontract part of it and do part of it. So what we do is that method one, on that one alone, how much will we spend? Method two, giving the man everything, how much is the total cost? So we'll look at which one of them will give you the shorter or the lower cost. That is what we will opt for. Now, because that is not a static price, so we adopt that method.
It's okay, sir. Thank you very much.
You're welcome. So if there's any other question, feel free to ask, and even in the WhatsApp group, or ask me personally, we'll provide answer for you. No problem. So I believe we can call it a day right now and prepare for the next class that you like to have. Thank you so much.
Thank you, sir.
So we'd like to call it a day. Thank you for being here. Until our next class, is goodbye.